So at least four different types of accounts. And I try to tell people, don't get too overwhelmed with it. Just think of it as you're wearing the same pair of jeans, there's just different pockets. Okay. It's not anything that's crazy or confusing. There are sites that you can use to kind of aggregate all the information, just look at it all in one place, or just keep all of your accounts at one brokerage firm, right? But I would initially say four, just one adult by themselves, at least four. Okay.
Welcome everybody back to another exciting show, the About That Wallet podcast, where we help you build strong financial habits. And I have an awesome opportunity to interview somebody that is actually from Maryland, just the way how I am. And he just having the moment to go across state lines and notice that the financial industry was a little different over there, even in just the education department. So he decided to come up with this company called Financially Present for Mawuli Vodi. Thank you so much for coming on the show, sir. How you doing?
Good, Anthony. I appreciate you for having me. Thank you for the intro.
And no worries. So what was it in your childhood that you felt was that you kind of wish you had known when you were younger?
It's funny because I don't know if there was one particular thing, but I feel like when I reflect throughout the course of my childhood into like teenage adult years, I was always a certain type of way with money. And it's because we didn't have much, things from hand-me-down clothes, Payless shoes, that was a regular thing in our household. And all the way to having to make requests for what you needed and saving money for little things here and there, and just knowing that maybe you feel a little bit bad asking your parents for money for a specific purchase, or I knew not to ask them for money for Jordans and stuff like that. So, I mean, there's always some underlying money concerns, I think, growing up. But what I wish I knew before was how to be comfortable with investing and how to be comfortable with my money working for me. And I learned a lot of that as I coursed through the industry as a stockbroker.
Now, our parents only can do so much with the knowledge that they provided us. And I noticed here on your website that you say Financially Present builds better communities by educating and empowering investors to change historical patterns and build generational wealth. But most of the time when we're growing up with our parents, they might have known the knowledge, but they just didn't have the finances to take advantage of all these opportunities. So what could somebody who is just starting out and they just living above or just over broke, or I call this a job, what can they do to kind of start, or what habits should they have to start taking themselves to the next level?
Appreciate that. There are a lot of different things that can be done, and I think a big concern is filtering out some of the noise, especially at that stage, because you're seeing things on social media about different get-rich-quick schemes, or sign up for a course here or there, or read this book. And what tends to happen is people will just get overwhelmed and bogged down. I'm a big self-help reader too, so I have a lot of books that I've started and finished, and a lot of books that I'm still trying to get to, just because I'm interested in certain topics. But I always tell people to start with the education first, and from there, and the education could look different. It could be finding a mentor. It could be plugging into a specific group or community that meets very regularly. It could also mean just finding a mentor or somebody, but just staying in the vicinity. And there's something to be said about, osmosis, learning through osmosis.
Yep.
Or just being around the right people. Some of that energy is contagious, I would say. And I think it'll do wonders for people. So at least starting with the education, being around people, I feel like in entering this space of being a financial content creator, I've had to create this space for myself, whether it's reading books, listening to podcasts, and jumping on Twitter spaces, and meeting so many other people, and then now going to different conferences and really connect with people, just like how I was able to meet you for the first time at FinCon. So it was pretty dope. But it's like I can feel this community, not necessarily just only being in my mind or in my office space, but it's a little bit out there. And I know I can kind of ping somebody if I have a question or need to do something.
Yeah. So you mentioned also talking about things that kind of stick, that last generation to generation. What is like maybe two or three things that you've noticed since you've been on this journey has been lasting across from generation to generation?
Things. When I think about Black folk, I'm noticing a lot of investing in insurance and in real estate, which is great. And for a lot of people, most of their wealth is going to be tied to their home, generally their first home, and that's how a lot of people are able to transfer wealth. But sometimes it's the ability to do it, or the knowledge of how to do that is not necessarily there, or it's not spoken of. And I would say that in recent years, I'm seeing a big growth spurt in that. In addition to the stock market, so owning investments and transferring them from person to person, having contingency plans in place, like these different aspects are, I can see it continuing to grow in familiarity with our community, and I feel like this is where it needs to be. We just kind of need more of this. Like when I speak to groups of people, I always tell them that the moment we have right now is this is your space, your time to ask questions. Nobody's going to look stupid at their when it comes to investing and trading questions. I feel like I've heard almost all of them, so there's almost no way to sound stupid, in my opinion. Um, but it's always up for debate for some people. But I always say, if you don't ask, the answer is always no. Like period. So I think it has a lot to do with that. And starting the conversation at home is so big. I got two young kids. I'm married with two kids, and they're in some of my content. They drive a lot of this too, because I want them to know more than I did. I don't want them to feel like they learned something by accident. I just want it to be just very intentional with what I do. So you might see them wearing the brand. They might the stock market on my TV is right up there, but it's on all the time. So when they come down into my office space, they're like, oh, okay, well, I know that the market is down today, so that means we can buy today, right, Daddy?
Nice.
Yeah, but like I want them to be comfortable seeing a down market and comfortable seeing an up market. So some of these things, like my parents watched, some late night TV, some CNN, some things like that, but we never talked about investing. That wasn't a thing.
Right. So, how do we start building that baseline education in the home? What should a parent do?
Right, and I'm actually exploring some different ways as well. And it has to be age appropriate first and foremost. My kids, they need some type of game to really hone in on some things.
What ages are they, if you don't mind me asking?
They are 5 and 7.
Okay,
So
so under 10.
basically crazy is what I'm. But no, it's a really fun age for them. Now they're in sports and things, but they're very competitive, which is also good. So we play stuff like Monopoly Go and things like that, where they can understand, like, okay, I'm acquiring property, or oh, this is how we handle money. We also do things like they have their own piggy banks, and I actually something different I've done is at the age of 3 for each of them, we started giving them allowance. And this was like a live case study. I didn't grow up with allowance, but it starts with having that money mindset and being able to make decisions at an earlier age. Because I realized that there's a lot of anxiety with spending and what to do. People hem and haw about, how they should navigate through this. And it's like if you do it with regular spending, it's going to be even more intense when it comes to investing. And with the kids now, they understand, hey, mommy and daddy cover their regular everyday things, their needs. But when it comes to some of the things they want, maybe it's a toy or candy or whatever, they can use money from their piggy bank to dictate that. And we generally don't wrestle with them too much about it. We were already noticing some of the behaviors that my daughter is more pensive. She thinks about things a little bit more critically before she makes a decision, whereas my son is be a little bit more impulsive, and maybe it's a guy thing. I don't know.
I think most of us are. You probably don't
Right.
have instructions on things until it fails, like the rest of us.
Those things have helped. It's made the conversations more regular in the home, talking about these type of things. So, and then they are very much aware that they have investment accounts. We don't necessarily have to go, we don't go into detail about like, hey, you have this stock or you have this ETF and things like that. At the time, at the appropriate time, we'll go into those details, but they know that they're invested.
Okay. So, we talked about, some of the things that they can talk about, but when it comes to the baseline investment education, what are like the key things should we all know about investing before we even start?
Right. I start the conversation with risk. Risk is going to vary from person to person. And just like how I mentioned, I've noticed some of these differences with my kids, how my daughter thinks a little bit more through her decision making, whereas my son can be a little bit more impulsive. The same thing happens with investing. So I start the conversation, whether it's with my kids or a large group of people, or even in some of the educational materials, like, hey, there's a big difference between a merry-go-round and a rocket ship. The the levels of risk and entertainment associated with both are going to vary. Same thing with the stock market, crypto, the bond market, mutual funds, ETFs. Like having an understanding of, and even if it's just a picture or an analogy that someone can relate with, is how you can frame the whole conversation and help people identify themselves. Say, hey, well, maybe I am more of a roller coaster person, and if crypto is represents a rocket ship, then I probably have no business doing that if I'm not ready for that. But helping people place themselves in this industry with just some examples that they can relate with.
So we're going to start with the baseline, which is understanding our risk. Once we understand our risk, because I noticed in the background you have buy low, sell high. Is that like one of the staples of investing? Or should that be like something that the kids should know or the parents should understand?
Right. It's almost like a universal tenet of investing. Ideally, when you buy something low, you sell it high, you will make some level of profit, some gain. And it can be used in the form of, some people talk about day trading, but it works even better with long-term investing. That's what I like to educate people on. But in any investment you look at, if you're able to understand buying low and selling high, then you'll be in an appropriate place. And I have invest in yourself for a reason as well, because that ties to the knowledge and just the self-betterment, being around the right people, continuing to stay on top of the news and things, because not only does it help people to generate wealth, but it also helps provide a defense mechanism. There are things that are going to reappear over and over again in I would say like a wolf in sheep's clothing, basically. So when we saw things like rug pull scams with crypto and things like that, if people had baselined their stock market education and understood some of the basics, they would have said, hey, I've seen that scheme, when people were day trading penny stocks. I noticed that. So it's like educating people in all of these different areas helps prime them so that they can say, hey, you know what? I know how to handle this advisor that may be trying to sell me a product I don't understand, right? Because some people are like that. Or maybe I know how to scroll past this advertisement because I know that investment's not for me. So it's all about priming people so that they can navigate through these waters.
Nice. So should schools teach investing? Should they be teaching this stuff now?
I would love for them to do it. I've spoken at some schools. I've talked to a lot of students, and they continue to tell me like, "Hey, we're getting some of the surface stuff, but we're not getting in deep." But they may talk about banking and loans and just some other basic aspects of personal finance, like filling out applications and a little bit about credit and things here and there, but not enough about investing. And building wealth is how you're going to be able to navigate through this life. You're either going to be, like you said, just over broke, right?
Yep.
Or you're going to thrive. Right? And I've just come to realize that as I speak to different organizations and schools, they're saying that especially the students are saying it's kind of falling short. And they will rely on things like YouTube University or jump to courses online. And I also think, not to digress, but I also think there needs to be some type of disclaimer as to the type of financial education you're going to get, because some people are teaching day trading, some people are teaching, you know, debt improvement or credit improvement. It's like, what part of financial literacy am I as a person looking for? Because everyone is on a different journey. Some people have been made comfortable with investing a little bit, or some people are coming from situations where they're scared of using credit, right? And debt won't be an issue, right? So maybe they need to be further along in the conversation, and we need to talk more about how they need to introduce some risk in their life so that they can invest. But it varies. It varies. But I really wish schools would not just only do the financial literacy box checking that I'm seeing. I really wish that they're inviting industry experts, whether it's advisors, stockbrokers, ex-stockbrokers like myself, and other people in the industry to talk a little bit more about the space, and not just simply some of what I've been seeing.
Right. You know, all these different things. There's so much out there about when it comes to investing. Should we even care about those other things, or should we just kind of keep it simple? Like, where do we start? Because we want to make some money.
Right, exactly. And yeah, it's a matter of trying to figure out which noise to tune out.
Mm-hmm.
And I would say at minimum, people need to figure out what is technical analysis, what is fundamental analysis. Am I looking at an individual stock, and can I determine, hey, this stock is trading above its actual value, right? Or is this something that is trading for a discount? And as the market continues to trade a little bit higher, it's harder to kind of perceive some of that. So you have to use some contextual type of some research, looking at the news, right? But I would take it even a further step back and say, hey, well, am I someone who is interested? Because some people say, hey, well, okay, Mawuli, you've given me all this information. I realize I don't know if I want to buy individual stock. It's perfectly fine. I work with people where they are. So one strategy I always recommend people is the core satellite strategy. Imagine having a anchor, the one main investment that all of your other investments are surrounded by. So almost like imagine a solar system. The sun is where everything in our solar system, revolves around. So the sun, for example, we're saying that's an index, a popular index. You can use S&P 500, for example. Perfect. That can anchor your portfolio, right? Unless surrounded by things that I'm either interested in, things that I've researched, things that I know that I can take a little bit of risk on, and then some other things that are probably keeping my portfolio balanced. Right? When you look at all of the different strategies, all of the gurus that are out there, they could be trending or not even trending at all, whether it's big names or people who are brand new and up and coming, they will tell you that there's going to be some level of diversification that you need. No one will negate that, because that diversification not only helps you be right more often than not, but it also will protect that portfolio from these bumps and bruises along the way. Because if you invest long term, you're going to grow long term. If you're only cherry picking 5 or 6 stocks and trying to day trade or swing trade, those type of things, that's fine, but you're still missing out. And for me, I always tell people it's better to be right more often than not. Right? And grow a little bit than to be wrong too often and right every now and then.
Okay. Because like for me, my risk is I usually try to take 20% off the top. If my stock goes out 20%, I'm out. Like
that's based on individual stocks.
That's individual stocks, yes. For the ETFs, or the index funds, depending on which one you want to go with, I usually just keep those long term. I don't really worry about those until my retirement. So those are my anchors that I have. And so I've been trying that out. So now that I'm using your analogy, that makes sense now.
Yeah, people are doing it, but they don't realize it, or they've never taken a step back and looked at it to see what it really represents. And if they take a step back, they might say, hey, well, I own this ETF, but then I own this tech stock and this and that. I might be over concentrated on the tech side, and I might be missing out on things like oil and gas and some other different industries. So it's really important to understand how that diversification can really help.
Yeah. So you mentioned, can you talk to us a little bit about IPOs? Like, what is that?
Yeah, IPOs, that's an initial public offering. The traditional way that it's done, I mean, I like to tell people that it's basically a fundraiser. That's all it is. A company that's pursuing, maybe they have a roadmap and they want to grow in a different way. They are looking to raise some funds, and the best way to do that is to go public. Right? You're taking your company from being a private company and saying, "Hey, we can make more money if we issue a few billion shares, and we have someone to help price it. We price those shares. We make the money up front. Yeah, we'll pay the people who need to help us go public. But after that, we keep that money. We can use it for just growing the company more. We can use it to leverage it in the future, right? But they make that cash initially. And then afterwards, the shares that are currently traded on the market are traded secondhand amongst regular people like you and myself. But the IPO itself, that market is very risky, right? Because you don't know enough about that company until they've been public for, I would say, several months or even years. And companies continue to evolve. So, but IPO is just a way to raise funds. You almost are essentially making something out of nothing. The faith of that company is what's producing the value of that IPO, the faith of what they do in the future.
Okay, that's good. So should people actually immediately, because you hear about some companies going public. I believe just recently you heard about like Uber and all these other tech companies going public. Is that something that we should all like kind of just jump right in head first and like, hey, this is an awesome opportunity to get in early? Or should we just kind of take a step back, wait? Like, what type of strategy would you recommend for that?
So first, I would say no, don't jump in. Take a step back and look, because it does require some research. The riskiest time to invest in a company is technically during that IPO process or during that the first 30 or some odd days. One reason I'd say that is because there are agreements that these companies have when they're going public, and they say, "Hey, well, we want to put the shares out there. We need to have some serious buyers that are willing to buy and hold at least for the first 30 days." Right? So those people, they get locked in. They buy at a specific price, and they're not allowed to sell the stock until after 30 days because they want some stability in the price. If those people got the shares and then immediately sold it, then you would see the stock price all over the place. And it creates a lot of volatility that people aren't comfortable with. So basically you have people who have been, they're part of the fundraiser, right? Or they believe in it and they want to buy and hold. It might be institutional buyers. They're buying millions and millions of shares potentially. But they're forced to hold on to it for some time. So you really don't even see the true value until at least after 30 days of the stock trading. And then from there, we don't even know how the company's performing earnings wise, what it actually looks like to say, hey, well, we project that next quarter is going to be, less revenue because of X, Y, Z. Like, those things you need to know you need to know that through time, basically. And you won't get that on the IPO date. You won't even get it for a few weeks. Right? So you need time to really understand how these companies are going to perform.
Copy. Now, for the second segment, which is talking about how to overcome some of those adversities, and some of us have been through some pitfalls. We bought some stocks and it didn't pan out well. Every time you buy it, it drops. Every time you sell it, it goes up. Like we just seems like we can't win. Are there any like strategies or habits that successful people in the market do that the rest of us aren't just getting?
Right. I've heard of multiple strategies and I've seen a lot of different things. I know for me, I don't think it's enough to just be right about one company. I own individual stocks. I own a lot of ETFs. In fact, I would say ETFs are the way to go because it allows you to reduce some of that research time. You can be right about the whole industry. I don't have to be right about the company, which is subject to the court of public opinion. Right? You can have one company with a CEO that's just doing too much or under fire or has a scandal here and there, and that triggers the performance of the company negatively, right? But if I have an exchange traded fund, which is an ETF, I can say, hey, well, I don't need to rely only on one company. If I know the whole industry is moving in this perspective or in this direction, I will be able to benefit from that. at least by capturing that. So I'll have indirect ownership of all of those different companies that are factored into that exchange traded fund or ETF, basically. So I think that's one of the best strategies. It saves on time and they're low cost, generally more low cost than mutual funds. And understanding the cost in your investment plays a big factor into the growth of your investments as well.
Okay. And so once we have that understood, has there been any habits that you've accumulated from growing up in an impoverished neighborhood to where you are today? Like what habits got you out of that?
Some of it is just being around the right people, being around the right industry, because I had more questions than answers, and I'm a kind of a jump in with both feet type person. So I started in the industry because I interned, and I was like, you know what, this looks like the best option right now, so let me jump on board and stay with the company and things like that. And I learned a lot being there. I think often I still wrestle with, okay, well, oh, that costs too much, or that's something that I've never had to buy this before, so let me see how I want to proceed with this. Or there's always this internal conflict, and it's like, oh, I am grown now.
I grown man, yeah, right.
Yeah, I found myself investing easily more in the stock market because of automation, right? Things like 401k contributions and automated transfers. These are things that, like, I always tell people, basically help you or save yourself from yourself, basically. And I knew for me that if I think too much about it, I might not do something. So I need to automate it so that I can reduce the amount of mental capacity that I have to use to try and contribute to an IRA or contribute, max out a 401k and things like that. So that when it's time to decide, hey, well, I have some cash on the side. Do I want to buy this stock here or there? Yes, no. There's less of that back and forth when it comes to some of the investing because of the rest of the automated investing. Okay. So that's, I think, a lot of what I've had to overcome. And when you do it long enough, it gets easier, right? When I tell people about, okay, the market is like when COVID first hit, and the market was dropping down like 20%. People kept asking, "What should I do? What should I do?" Yeah. I said, "Well, buckle up." I said, "If you got money on the sidelines, you're ready to invest." Because I jumped in the industry in 2008. Right, and that was the most exciting time of investing, anyway. At least for me. The only thing is I didn't have much. That was the main issue, being an intern. But you had to get used to seeing the ups and downs. And once I saw the ups and downs, I was like, "Oh, this is not so bad. This is not as uncomfortable as people make it seem." If I were of retirement age, that would have been something different.
Okay, so you have a small video that I'm looking at. It brings up a good question. How many investment accounts do you need? From the Roth IRA, you got the individual, you got your joint, your savings, your HYSA, you got your UGMA, your UTMA, like all these different things out there. How many investment accounts do you really need?
It depends on the person. If you have a family, that does change too. I know for me, because I manage accounts for myself, my wife, my kids, and a couple of nieces and nephews, there's at least about 13 different accounts. You don't have to be like me. You can make it much simpler. I think for every adult, you at least need to be investing into your 401k. You need to have a traditional IRA, a Roth IRA, and then an individual brokerage account. So at least 4 different types of accounts. And I try to tell people, don't get too overwhelmed with it. Just think of it as you're wearing the same pair of jeans, there's just different pockets. Okay. It's not anything that's crazy or confusing. There are sites that you can use to kind of aggregate all the information, just look at it all in one place, or just keep all of your accounts at one brokerage firm, right? But I would initially say 4, just one adult by themselves, at least 4. Okay. And it can get more complicated with that. But for example, me and my wife, we don't have individual accounts. We have a joint brokerage account. So that plus all of the other different things. But she has her own individual IRA, or individual retirement account, which is an IRA, Roth IRA. The kids, they got their own custodial accounts. They got the 529 plans. So it can be a lot. But if it's automated, that makes it much easier.
Yeah. So okay. So a lot of people right now, Roth seems to be the trending topic. If you had an option to invest or max out your Roth versus your traditional, which one would you rather do?
So this is more of a individual tax situation,
Okay.
right? So I've spoken to some CPAs, and they'll tell you, hey, well, you're in investments, money now is better than money later. So they'll say that they're not always pro Roth, right? CPAs, or some of them. It really depends on your tax situation, right? And this is why personal finance has to be personal. It has to be something that you're talking to professionals about regularly, individually as well. You get, and I say all this to say that you get the deduction with a traditional IRA, pending your adjusted gross income, right? But you don't get that with a Roth IRA. All you get is a promise in the future saying that, hey, this money, if you take it out, it's tax free with a Roth, which is good, right? But there are no guarantees we'll be here when it's time to pull the money out. IRS could change the tax code, which I really don't think they're going to. I don't particularly think they're going to want to mess with Roths because they're going to have a lot of angry people to deal with. But if you're looking for the deduction, then traditional IRA or 401k is like the better way, right? Because you get to deduct that from your taxable income. It will reduce your income for the year and possibly keep you under a certain bracket, right? So check with your CPA because I'm not a CPA.
Got it.
But that's how it works. And with the Roth, if you know that you're just looking forward to the future and saying, hey, well, I anticipate that my financial situation in the future is going to need, or Roth IRA is going to be favorable for my financial situation in the future, then that's the way to go, for sure. The reason why I have both is because I want some balance. I want to be able to say, hey, I got some tax-free money. I got some money that I will pay taxes on, and I can still get deductions through the tax code in the future. So I think it's more appropriate to have some taxable and untaxable money.
So for the third segment in the futures, what skills or habits that you feel will take you to the next level? Or
skills and habits for me, I think more automation. Right, I like the idea of AI. I'm not particularly scared by it, but who knows? Who knows? I'm one of those people where if I need to pivot, I'll pivot as needed. But I think using some automation in different aspects of my life will make things a little bit easier to take it to the next level and service and help more people and things like that. Other things that would help take me to the next level, more investing, right? I feel like you can't have enough investments, in my opinion. I want to branch out to other investments as well. Like I do a little bit in real estate. I'm a homeowner as well, but I'm not one of those people that wants to have a whole bunch of properties and do all that. No, I'd rather be more of like a hard money lender or someone that just, jumps in and out of home flips and just, could slide you a check and then you send that check back with the interest that you promised, that type of investing. So I've done that a few times. Right, but I'd love to do a little bit more of that and continue to diversify in different ways so that it's not just only the stock market, right, and not just only our physical home, our primary residence, but other investments. And I think that takes time, just to be able to do that. And then there's some other business ventures that I'd like to do too, as well. In my mind, I would love it for my kids to own vending machines, right, and document that as well as part of the process of something else.
Yeah, I got several episodes if you ever need to listen to them about getting into the vending industry.
Down. I'll check them out.
Is there anything you want to say before the final 4 questions that you want to leave the audience with?
I can't stress enough the education, right? But the education is not good enough if you don't apply it anywhere. You have to use it. If you find yourself listening to podcasts and it's a year later and you're doing the same thing, only listening to podcasts or only reading books, and something's got to change, you might need a mentor or someone else to help with accountability and just to really move to that next level. So it might mean expanding your circle or inviting someone into your circle to help you grow.
Okay. Cool. Are you ready for the final four?
Sure.
All right.
We'll see.
All right. Number one, what does wealth mean to you?
Well, to me, I think it has to be dictated to my time. For me, I'm about spending time with my family, spending time. I'm a musician, so I like to play instruments at church, right? So my faith is big to me, but my family, my faith, and finances is just, I always tell people that's just the language I speak. But in being able to be quote unquote wealthy, it's not only a dollar amount, it's how I dictate my time. Because for me, if for some reason financially present doesn't allow me to be able to help out at my daughter's softball practice or coach my son's baseball team, then I have to change things up to make sure that I'm not missing these critical years, because it is a lot of fun for me. I never played baseball, but it's been a lot of fun seeing my son and his friends grow and develop in such a different way. And I don't know, it helps me exercise things a little bit differently. But that, and then I also have to spend time being a husband as well, and I enjoy that. And that means date nights. That means, quality time. I'm a big quality time person, so.
It sounds like the wife is in there watching you right now. Like, yeah, my wife. I thought gotta talk right now.
No, we've been together for a long time. Put myself on the spot, but almost 17 years.
Oh,
almost
wow.
17 years, and then we'll be married. We've been married 11 and a half years, so we have a lot of fun together. But either way, if I get to the point where for me, if wealth was defined by society and not by me, then I feel like I would lose, right? Because I'm not the flashy guy. I don't necessarily even care about some of the name brands. I like to be able to dictate my time and do what I want to do.
Yeah, I don't even know half the brands. Like, who's Balenciago?
Right.
I don't even know how to spell it.
And I'm okay with it.
Nice. Number two, what was your worst money mistake?
Worst money mistake. So I documented this in one of my ebooks. So when I first started working full time, I wasn't making much, pennies in retrospect, but my manager was like, "Hey, max out your 401k. Put as much as you can." I was like, "There's no way I can max it out making like 30 something thousand." It was, like I said, making pennies. But I did as high as I could, and I started at 15%. I got the first paycheck or two, and I was like, "Man, this is measly. I can't do this." Like, I bumped it down from 15% to 10%.
Mm-hmm.
It's like, man, I still can't do this. I bumped it down to 7%. That was my mistake. I bumped it down and I left it there for like years and years and years. Right? I eventually made the correction, right? But this is someone who's in the industry helping people with investments, but like my own, it's like I had to wrestle with it to the point where I kind of just forgot. I was enjoying some of the pay increases over the years, but I didn't go back and change that amount. And I always tell people that it's better to start high, because once you start low, it feels so much harder to try and increase it. But if you start high, you can definitely dictate your situation a little bit better. So that was my money mistake.
Number three, what is your favorite financial or non-financial book?
It's definitely going to be self-help related. Financial, I really like the book, The Psychology of Money. I enjoyed it a lot. I read it earlier this year, and I've read a lot of finance books because I'm a finance nerd, as you may come to see. But I really liked how that book was written, the examples they gave, and the mindset that it helps you kind of achieve when you look at investing. It was well written and easy to read, I'll say. But there's a lot of other books out there that I like as well. But, some of the other non-financials, I like the Meaning of Marriage by Tim Keller. That was a book I read right before I got married, and then a book that I still point people to. So, yeah.
I've never heard of The Meaning of Marriage.
Yep, The Meaning of Marriage by Tim Keller.
Okay, I meant to take a look into that.
Yeah.
All right. Number 4. What is your favorite dish to make?
Okay. So I'm from Ghana, man. You know, I was born in Maryland, born in PG County, Maryland. But at the same time, too, I grew up in a Ghanaian household, so we have a lot of amazing dishes. And I want to say I like to make some jollof rice. You know, I know we got beef with the Nigerians on this, and even the Senegalese people. And I've spent some time in Senegal. They do it right too. But I enjoy making some jollof rice because that's where it's at. There's a whole bunch of other soups and stews that I enjoy, but jollof rice is on the easier side to make, so I enjoy that.
Awesome. All right. The very last question of the show, which is, where could people find out more about you?
So you'll definitely find me online, whether it's on Instagram or YouTube, at Financially Present. So just as it sounds, it's financially present. And then also my website, financiallypresent.com. You'll find resources, articles, budget spreadsheet, online course, and a way to book me. If you need someone to educate a group of parents and their teens, I'm there. I'm your guy.
Awesome. All right, everybody. Thank you guys for joining us during this episode. Hopefully you got some value. If this episode actually impacted you in any form or fashion, please make sure you share this and actually like this episode so that more people can find out about me and actually get to learn a little bit more about their stock portfolio. All right, everybody. Y'all be safe. I'm out. Peace.